The sixth learning objective is to classify costs and prepare an income statement and statement of cost of goods manufactured for a manufacturing company. Manufacturing companies use labor, equipment, supplies, and facilities to convert raw materials into finished products. Managers and manufacturing companies must use these resources to create a product that customers want at a price customers are willing to pay. Managers are responsible for generating profits and maintaining positive cash flows. In contrast with service and merchandising companies, manufacturing companies have a broad range of production activities that require tracking costs on three kinds of inventory. Materials inventory includes raw materials used to make a product. For example, a baker's raw materials include flour, sugar, and eggs. Materials to manufacture a DVD include casings, color insert label, blank DVD, and software program licensed to each DVD. Work in process inventory includes goods that are in the manufacturing process but are not yet complete. Some production activities have transformed the raw materials, but the product is not yet finished or ready for sale. A baker's work in process inventory includes dough that's ready for cooking. A DV manufacturer's work in process could include a DVD and software program, but not the casing and the labeling. Finished good inventory includes completed goods that have not yet been sold. Finished goods are products that the manufacturer sells, such as a finished cake or a boxed DVD, to a merchandiser or directly to customers. A direct cost is a cost that can be directly traced to a cost object, such as a product. Direct materials and direct labor are examples of direct costs. A cost object is anything for which managers need a separate breakdown of its component costs. Smart Touch's DVDs are an example of a cost object. Managers may want to know the cost of a product, a department, a sales territory, or an activity. Costs that cannot be traced directly to a cost object, such as manufacturing overhead, are indirect costs. Indirect costs are required to make the finished product, but are not as easy or cost-effective to track to one specific finished product. In manufacturing companies, product costs include both direct and indirect costs. The completed product in finished goods inventory is an inventorial product cost. The inventorial product cost includes three components of manufacturing costs. Direct materials become a physical part of the finished product. The cost of direct materials, purchase costs plus freight in, can be placed directly in the finished product. Direct labor is the labor of employees who convert materials into the company's products. The cost of direct labor can be traced directly to finished products. Manufacturing overhead includes all manufacturing costs other than direct materials and direct labor. These costs are created by all of the supporting production activities, including storing materials, setting up machines, and cleaning the work areas. These activities incur costs of indirect materials, indirect labor, repair and maintenance, utilities, rent, insurance, property taxes, manufacturing plant managers' salaries, and depreciation on manufacturing plant buildings and equipment. Manufacturing overhead is also called factory overhead or indirect manufacturing costs. Direct labor and manufacturing overhead combined are called conversion costs because the direct labor and the manufacturing overhead convert raw materials into a finished product. Manufacturing overhead includes only those indirect costs that are related to the manufacturing operation. Insurance and depreciation on the manufacturing plant's building and equipment are indirect manufacturing costs, so they are part of manufacturing overhead. In contrast, depreciation on delivery truck is not part of manufacturing overhead. Instead, depreciation on delivery trucks is a cost of moving the product to the customer. Its cost is delivery expense, which is a period cost, not an inventorial product cost. Similarly, the cost of auto insurance for the sales force vehicles is a marketing expense, which is a period cost, not manufacturing overhead. Manufacturing overhead includes direct materials and indirect labor. The spices used in cakes become physical parts of the finished product, but these costs are minor compared with the flour and the sugar for the cakes. Similarly, the label is necessary but minor in relation to the DVD, the case, and the software. Since these low-priced material costs cannot conveniently be traced to a particular cake or DVD, or are so minor that we don't want to trace them to a specific cake or DVD, these costs are called indirect materials and become part of manufacturing overhead. Thus, indirect materials are materials used in making a product, but whose costs either cannot conveniently be directly traced to specific finished product, or those costs are not large enough to justify tracing to the specific product. Like indirect materials, indirect labor is difficult to trace to specific products, so it is part of manufacturing overhead. Examples include the pay of forklift operators, janitors, and plant managers. Keep in mind that with indirect costs, there is often professional judgment involved as to whether a specific cost is part of the product manufacturing overhead costs, or if the particular cost is not related to the manufacturing of the product, which is a period cost. Direct costs, direct materials plus direct labor, plus manufacturing overhead, indirect materials, plus indirect labor, plus other direct, indirect manufacturing costs equals inventoriable cost. This table compares product costs, which are part of inventory, to period costs by company type. Since service companies do not produce or sell products, they have no product costs. Merchandising companies purchase their inventories and have similar expenses to a service company, with the addition of delivery of the inventory. Manufacturing companies are the most complex. They have 3 product costs plus period costs. Note that the period costs are all related to selling and administrative type expenses. The income statement of a manufacturer is similar to that of a merchandiser, but with some important differences. Notice that the cost of goods sold is computed using the finished goods inventory. Since manufacturers have 3 types of inventory, it is important to specify the type. Also, instead of adding purchases, cost of goods manufactured is added to the beginning finished goods inventory. This amount is separately computed. This diagram shows how the product costs turn into period costs when they are sold. The cost of good manufactured summarizes the activities and the costs that take place in a manufacturing plant over a period of time. Let's begin by reviewing these activities. Exhibit 16-9 reminds us that the manufacturer starts by buying materials. Then the manufacturer uses direct labor and manufacturing plant and equipment overhead to transform or convert these materials to work in process. When inventory is completed, it becomes finished goods inventory. These are inventoriable product costs because they are required for the for the inventory production process. Cost of goods manufactured summarizes the activities and related costs incurred to produce inventory during the year. The income statement line item, cost of goods manufactured, is a separate schedule. It begins with the work in process at the beginning of the period. The three product costs are added: materials, labor, and overhead. The ending work in process is subtracted to determine the cost of goods manufactured. This table shows the flow of costs through three inventory accounts. You can see how the bottom line of one schedule flows to the next. Also notice that each schedule starts with beginning inventory, has items added, and then ending inventory is subtracted. Short exercise 16-9 reinforces how to compute direct materials used. Short exercise 16-12 is an example of computing cost of goods sold manufactured.